Hello and welcome to the Harwood Report for September 10th, 2017, presented by Trade Academy. I am your host, Keith Harwood. Start with the disclosures. As always, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read this entire slide. Key here, Trade Academy is not an investment advisor. It's not registered with the SEC or FINRA. Nothing that I say here should be considered to be trade advice or a trade recommendation. You need to do your own due diligence before you enter into any trade. This week, I always start with the equity indices, S&Ps, Nasdaq, Russell, and Dow Jones. We'll go through those just to get a general macro picture, and then we'll turn our focus to the dollar-yen pair that I've been focusing on. It's getting a little bit less exciting to me just because of the magnitude of the move, but we'll talk through it a little bit and what we see in gold and treasuries. Then we'll go into some sectors. I think there's some interesting stuff developing in the sectors there. South Korea, energies, and financials. So without any further ado, let's get going here. S&Ps, it was a kind of choppy week. So we had Friday closing looking like a breakout potential. North Korea and Harvey and Irma and everything just kind of gave a little bit of a spook to the market, a little risk off Tuesday, shortened week. Tested the 50-day moving average, but really rejected that selling pressure and got back immediately above both the 20 and the 10. So it still looks like there's a little bit of an uptrend in place here. As long as we continue to hold the 10, 20, and 50, and really the key there is the 50, I think you're going to have a general bullish tone to the market. Nothing happened with North Korea this weekend. There was a potential that they were going to test another bomb. Obviously, that could happen after I'm done with this report, but right now my expectation is that North Korea is going to be kind of forgotten for the week, or at least to start the week. There's not going to be as much concern about what North Korea might do next. The market has a short memory, so if nothing happens for a week, then the bears kind of start to lose their conviction that North Korea is going to start a war. With that in mind, you can see that we've been doing a little bit of consolidation here, creating a little triangle. I think we're going to see moves back above last week, or the previous Friday's high here, which was 248.33, and try to test for this 249 level, we'll call it, to make a new all-time high. So we've got a little bit of a general bullish undertone to the market. Vol in the S&Ps is a little bit elevated because of concerns about North Korea and hurricanes going into the weekend. So I don't think you want to trade this via outright options. But I think that you can then use that general tone to then find better sectors to trade options for that move. Let's make sure that we don't see anything particularly difficult or different in the other sectors. Nasdaq, a little weaker on Friday. Part of this is because of the risk-off tone. So they had, generally this has been one of the favored sectors. There was a little bit more selling, but we're still closing right on the 10-day moving average, not even really testing the 20 or the 50 too aggressively. So I think that we'll see a little bit of buying there on the Monday morning. Russell actually was the best performer on Friday. Part of this is because it's kind of underperformed, and a lot of people have been long tech and short some of the small caps. You can see that we've got a much bigger distance to make up here to get back towards new all-time highs around 144. So IWM might be a little bit more interesting to play on the long side. Look for that breakout above 140.89 for the week, for Tuesday morning and really the week preceding. But generally, again, I'm not necessarily looking at IWM for my actual trades here. If I was, I would say that IWM is better, or more interesting to me than S&Ps, just because you've got a little bit more room to play around here towards pushing towards new all-time highs. So you've got a potential for a $5 move to get to a new all-time high versus S&Ps is only $2 away. It just creates a little bit more open trade potential there. Again, though, not really my focus. We'll go into the better sector trades later. Finally, Dow Jones. It's been testing the 50-day moving average. I expect, again, this has been holding, and it's been holding well. So we'll look for a general bullish tone to start the week. So let's talk about, first off, the pair trade that's actually given a little bit more of a risk-off tone, and that's the dollar versus the yen. So last week, closing right around the 10 and 20-day moving average. This week, we just couldn't hold above. I expected with everything going on that we would probably see a little bit more of that trend continue. We had a couple days in a row of closing above the 10 and 20, but I think all of this concern over North Korea and the hurricanes gave a little bit of a safe haven demand, which meant sell the dollar, buying in gold, buying in bonds. At the same time, they didn't sell off the equity market. They just added some protection rather than liquidating longs. With nothing really significant happening with North Korea, once again, as I've said a few times, I think that you'll have some people taking off some of that protection. It should hit the VIX down. Should be put a bid into the dollar versus the yen. We'll look for it to retest the 10 and 20-day moving averages around 109, a little above. When that happens, if that happens, we'll be at a big inflection point, and we'll have to see whether risk on continues and we put equities to new all-time highs and start pushing gold and bonds lower, or if this is just the level of fade. So right now, I normally don't look for a play this way where we play for a bounce below the 10 and 20-day moving average, but I think that you'll want to more than likely look for this to bounce. Now, if something changes where dollar yen opens weak tonight or tomorrow morning, then I'll abandon that thought process and focus on the bullish side of either gold or the treasuries. But I think right now, I'm expecting to see a bounce in dollar yen, and thus I think that we'll see a little bit of weakness in gold and an initial weakness in treasuries. So let's start with gold. Oops, GLD. This has just been rocking. We've focused a lot on this over the last couple of weeks because of the way the dollar yen has just been holding below the 10-20 moving average. This past week, I've been a little bit less convicted on this trade. There wasn't a lot of clarity with dollar yen so close to the moving averages. Obviously, we now know what happened over the week as there was some risk-off demand and some safe haven demand. Now we had this inside day on Friday. A break below 127.59. And I think that at a minimum, we're going to test the 10-day moving average. And more likely, we probably test the 20-day moving average. The 10-day moving average hasn't been a huge level of support. You can see the 20 has been more supportive there. So that gets you down towards 124. So let's look at the options for this kind of play. Go to GLD here. First off, I want to note that in terms of volatility over the last 6 months, we're near sort of some of the recent highs. Obviously, you've got 16% if something gets real crazy. But right now, recent highs around 12, 13%. If gold starts to fall, I expect to see volatility drop back down towards this 10.5, 11%, more mid-range. I don't necessarily look for it to go all the way down here below 10% unless dollar yen flips to that bullish trend and gold gets back a lot lower. To play for that move to 124, if we look at September 15th options, that's this week. Let's look at a daily move right now is 0.75%. Over the course of a week, we're looking for something around 1.5%, maybe up to 2%. 2% in this market would be $2.50. That would get you down to 125.5. So if we go an extra week, 10 trading days, you got about a little closer to 2.5%, and that gets you down to around 125. So for us to really get, I think, through that 126 level and test towards 124, we're probably looking for 2-week options. I don't expect us to just blow through the 124 level. There should probably be a little bit of buying, some support there. The way I like playing this, though, is through a spread. So you note that the volatility on the 126 puts is 12.5, 13% range, a little under 13%. If you go down to the 124 puts, it's actually closer to 14%. If we start to fade, I don't necessarily think vol is going to come up. I think that's coming in because we've got risk on. VIX is getting hit. Gold is just getting hit because there's no need for the safe haven. It's not that I think the 124 puts are particularly expensive at 15 cents. I just don't think they're going to come into play. I may be wrong. We could go down to 122 or 121. That'd be a pretty fast break here. But I think that if you look at cheapening up the 126 puts, you buy the 126 puts for 45-ish. Sell these 124 puts around 15, 16 cents. You got that put spread for 30 cents. On a move to 124, it's worth $2 if you hold it to expiration. More likely, I'd be looking to exit this somewhere between $1 and $1.30. Even at the low end at $1, if futures get down to 125, that gives you a 3-to-1 R&R. So I think this is giving you a pretty nice window here, buying this put spread for 30 cents. And in particular, it's partially because of this skew that I don't think is necessary here. So in GLD, I'm looking at put spreads. I think this is a really interesting trade, partially because of the skew and partially because of the way I think bulls would get hit if we get that pullback towards the first 10-day moving average at 126 and then the 20-day moving average around 124. On the other hand, if we see dollar-yen weak tomorrow, risk back off, everything looks a little bit scarier, I actually pull up TLT as my way to play that. And the reason is because this is not actually near as high up relative to the long-term history, and I think yields are going to get hit, and you've got a little bit of a gap here, and we're not as far away from the 10-20 moving average, so you've got a little bit more potential for that support. In any case, I think you could very easily look at a move towards 132 here. If we open up a little weak, as long as we hold above, if we hold above Friday's low, I think you can look on the bullish side, but as soon as we break below Friday's low, you have to hold off on any trade here, wait for a move back above. Later in the week, you'll have a different potential low level, but for Monday in particular, if we open up below 128.57, I don't think you want to be doing any buying in TLT until you find that support level. It could be the 10-day, could be the 20-day, and there could just be no support. If you get below, say we trade down to 128 and then bounce, on a move back above 120.57 is where I'd be looking at potentially entering a long trade. What's that trade going to be for me? Looking at September 29th, 3 weeks, we'd be looking for about a 3% move based upon an average daily move of about 0.75%. So 3%, about $3.50, close to $4, and that would put us between 132.5 and 133. Because I'm saying that I initially expect a little bit of a dip, I'll target closer to the 132.5 range as my ultimate target. The way that I'm wanting to structure this is similar to what I was doing in gold. I do expect vol to be bid into a rally, so the skew is appropriate here. But because there's this skew, it helps me cheapen up the options if we get a dip. I'm still only looking for a move towards 132.5. I'm not looking for this breakout move to 135 or 136, and because of that, I can still do a call spread. And I think that these 132.5s at 40 cents are a little bit overpriced, because that tells you that you'd have to move to at least 133 just to, or 132.90 just to break even here. You have to have something else change, I think, to get that real breakout type move that gets you more than a standard deviation in TLT. The way, though, that I'm going to be looking at structuring this overall is then if we get that dip and then I get my buy signal, which was a move back above Friday's low, I'm looking to buy the 131, 132.5 call spread. It's around 26 right now. Ideally, I'd be getting it closer to 22 or 21 cents. That would be a pretty nice entry level. Then into a rally towards 130, 131. I don't want to necessarily take the money on this yet, but I do want to try to reduce my risk. And so the way I will look to do that is to sell the 132.5, 134 call spread. This is what you're ending up with. A butterfly. Long one, 131.5 call, long one, 134 call, and short two, 132.5 calls. The profit on this is optimized on move to 132.5. Currently, that's valued at around 12 cents. If we use some of this directional bias in our favor, and I can get some of these 131, 132.5 call spreads closer to 25 cents or lower, and then into a rally, sell the 132.5, 134 call spread at 25 cents or higher. Now I've got this butterfly on for free, where the worst it can be worth is zero. If we pinned 132.5 on September 29th, it would be worth $1.50. I don't expect to hold it that long, obviously. I would hold it into that expiration week, though, if this starts to work, and look to exit somewhere in the 60-cent range. If I can get into something today for 12 cents that I could exit on expiration week for 60 cents, that sounds pretty good. There's a lot of commissions here to do this. That's why I want to use my directional bias to work into that trade. When you have 4 trades, if your total commissions and fees are about a penny per contract, you're going to end up paying And when you pay 12, you're really paying 16. And then when you exit for 60, you're really exiting for 56. So you've got a little bit of concern with the commission there. But I would rather have the butterfly on than completely exit the 131, 132.5 call spread for like a 15 or 20 cent profit after getting in at the 20 to 25 cent range. I just think that there's a lot of ways to massage this trade into something a little bit more profitable and take advantage of that grind higher potential. Again, though, this is all predicated on dollar yen not showing any real strength and the risk off trade continuing. So moving on from TLT, let's get over to some individual sectors. EWY is the first one for me, and that's because it's South Korea, the perfect trade to look at as a result of a lack of action from North Korea. Each time North Korea has done something, South Korea gets hit. First, we were getting hit down towards the 50-day moving average, and then North Korea actually did a couple things, made a couple threats. We got down to the 100-day moving average. Last week, we got just below the 100-day moving average. So all this North Korea stuff has definitely impacted the South Korean ETF. We've held the 100-day moving average well. There is no news. That should lead to a bounce back up to at least the 50-day moving average here, just under 69, and potentially all the way up here towards just above 69, towards 2 weeks ago highs, which were 69.46. If and when that happens, volatility is likely to get hit. So you can see in volatility, it's currently trading around 21%, expected to drop down towards 18% into a rally. Okay, so because of that, again, I'm looking at a complex trade. So this is what I was looking at in terms of this week getting the bounce. And I'll tell you how I'm looking to trade this. September 15th, sorry, I'm looking at last week's expired options. So the market's pricing in about between a 1 and 1.5% move every day. In reality, we move closer to 1%. For a week, that means maybe we can get about a 2.5% move. So 2.5%, we're looking at less than $2. That would be 3%. If we get a, say, $1.50 to $2 move, that's going to put us around 69, which actually fits really well with our chart target. If we get a little overshoot towards 69.5, that fits really well with this butterfly. So if I can get into this same way that I was talking about in TLT, where I start by buying the 68.5, 69.5 call spread, and then leg into the next leg by selling the 69.5, 70.5 call spread into a further rally, then I've got this really nice price window where I don't think that we're necessarily getting above 69.5. I understand the 69.5s look a little bit cheap there at 9 cents. They are dollar cheap. But what's going to get us to push above those highs from 2 weeks ago is likely a de-escalation of tensions in North Korea. And I think right now we just have a lack of new information. So I don't know that we can justify an explosive move higher, but we can justify a drift higher. That's why we don't necessarily need to buy outright calls. If we want to buy outright calls for an explosive move higher, we'll do a call spread for a little bit of a move higher and then leg into a butterfly for that grind higher and then vol getting hit. And then obviously, I expect that as we get above 68.5 towards 69, 69.5, that the market probably just kind of stabilizes and says, okay, now let's wait for the next piece of information. That's basically what my trade is telling you. Is my trade here is saying, I think we'll go a little bit higher initially and then consolidate for a few days. So I'm looking to try to figure out a way to get into this call butterfly closer to a dime. I don't really want to buy the butterfly outright for 14 because with commissions and everything, even if I pay 14 or 15 or 16, we're now starting to pay a little bit too much money for a tight butterfly. So I have to be able to leg this, and I have to be able to leg it for the right levels. If I can't leg it, then I can't do this one. But I do think that we will get a bounce in South Korea. If you want to play it without the options, then that would be the alternative. I don't think you want to do this with outright long options. You can do the call spread, just do the 68.5, 69.5. I prefer doing the call spread and then legging into a butterfly, but again, this is a little bit of a tougher trade just because it's all so quick. And we have to see South Korea open near these levels on Monday in order to get into this, because if this ETF's already trading 68.5 on Monday morning, we're never going to be able to get anything in near these levels, and we just have to walk away. Focus on the other trades if that happens. One of those trades is XLE. So this has nothing to do with North Korea, and this has everything to do with hurricanes. We've had a nice rally in XLE over the last, say, 2 weeks. But we've done what we often do. We've been in this long downtrend. Through that downtrend, we retested key moving averages. Here we were testing the 50-day moving average. Failed. Finally broke through, tested the 100-day moving average. Failed. It's less, we don't often see the first retest succeed unless something fundamentally is changing. Right now, there's a lot of fundamental things changing due to hurricanes. If we get back above the 100-day moving, if we get above the 100-day moving average because of something going on with Irma, I'm not going to get out of the way of I'm not going to get in the way of that market. I think that's great. Oil firm on Monday morning with all the products firm and XLE firm. I'm not going to get in the way of this trade. As long as we stay below the 100-day moving average, and in particular, I'm looking to hopefully stay below Thursday's high, which is 65.25. Then I'm looking at something bearish here. And a retest of 62 would be my target here. I don't know that we're going to make new all-time lows, but in the short term, I can play for a move back down towards 62, and then the market can decide where to go from there. So here we go. Let's do it again. Go over to the options. For a move to 62, every day right now implied vol is implying a 1% daily move. We're getting closer to 0.75%. 62 is about 4% away. So if I look at something that's about 3 weeks out, September 29th, you get a little bit of leverage on a move to 62 by doing something like the 63-62 put spread. So at 3 weeks, you should see something between 3 and 4% on the move. If you get 4%, that's about 260. Gets you just below 262. It's closer to 3%. It's closer to 62.40. But if you get the 63-62 put spread, around 28 cents, you're actually doing pretty well. You got a nice little skew here. Vol should actually increase into a break, so that's appropriate. But the key here is, again, you got to get the right entry level. If you get this put spread for 35 cents, it's no good, because I'm looking to exit it when it gets to around 60 cents. So this is kind of a double to a little bit more, a little more than double your money if all plays out according to plan with the break after retesting the 100-day moving average. But you're not going to, look at, this is not a home run. This is, if you held it to expiration, you might triple your money, maybe a little bit better, especially if you can buy this into a bounce where you're buying it closer to 25 cents. The level matters here for sure. It's simple as that. If XLE opens up at 63 on Monday morning, I'm back to that point where I don't have a trade here. If XLE opens at 64.5, I'm really happy, because now I can look at potentially buying that put spread. Hopefully even with vol a little bit lower, because of my expectation that the VIX should get hit, since assuming the market doesn't get hit too much overnight, which I don't think it will, as I mentioned earlier. Finally, XLF. So this plays back into the idea that the dollar yen should firm and should bounce. XLF, a lot of people were talking about on Thursday, breaking below the 200-day moving average and closing below the 200-day moving average, and that looked really bad, looked really negative. And then on Friday, the market bounced. Said, never mind, we're not going to worry about that too much. If dollar yen weakens and treasury yields start to increase, we should start to see some money flow into XLF and maybe a retest here of 25. And to play for that trade, okay, nope, I did not have it in the complex. So I was looking at a call spread here. We're going to do it off of the weeklies. So every day we're expecting about a 1% move, but the problem is, again, volatility, 16, 17% is very high for this product. It should drop back down towards 13% in that kind of rally. But the market's not skewed that way. Right now, a small rally is 16.5%, and a large rally is 16% implied vol. I don't think vol is going to be at 16% on a move back towards 25, 25.5. But let's assume you're going to get a 1% move per day. Then the move through here should be about 5%, which would put you to 25.30. I think you get a little less than that because realized vol has been a little lower than 16%. So that puts you between 25 and 25.5. If you got the 24.5, 25.5 call spread for 20 cents, you actually have a decent R&R there, probably 3 to 1. You look towards selling that out at around 60. If you want something a little shorter, you can look at buying this September 24.5, 25 call spread. If you can get that for 6 or 7 cents, that would be a pretty good R&R as well. Mostly because these 25s, if they are 4 cents, if you could sell them for 4 cents or even 3 cents, they're kind of overpriced. I don't like selling them for 3 cents because of the commission portion, but at 4 cents, it's okay. So as long as these are 4 cents or higher, I like buying that call spread. Otherwise, I would just focus on the October 13th. So basically, you'd have to buy this for 7 cents. In a 2-week move, you'd be looking at about 3%, which would put you at 24.80. That's why that works. You're buying this tight call spread that for 7 cents that you're looking to sell out again at 25 to 30. But I like, when I'm doing the call spreads, I like to go a little bit longer term, just in general, because as I mentioned in the South Korean and ETF, there's a lot of commissions into doing multiple contract complex trades with short durations. So you can make it a little bit more structural, which means you want to have a little longer holding period and a little bit more time for that trade to work out and a little bit of wider strikes. So my key here is the 24.5, 25 5.5 call spread around 20 to 21 cents, and look for that to potentially double or triple in value over the course of the next month and change. And if the move happens faster, you are still making money just off of delta and the expectation that vol should get hit. So this is a week really focused on call spreads and complex orders, and a lot of that's due to the VIX. The VIX just being a little bit higher than I would want. I don't necessarily think that the VIX is going to make new lows here, but you should see a move back down towards 10.5%, and that matters when you're pricing out all of these options and playing for a rally. You want to be more call spread and butterfly focused than just playing for breakouts when we're not trading near those new all-time highs in a lot of these trades that I'm looking at. Contact me. The website, tradeacademy.co. My email is keith@tradeacademy.co. Feel free to send me an email if you have any questions or comments. Call me 312-600-8004. And follow me on Twitter @TradeAcademyCo. I'll put in more comments about how I'm seeing the markets as the week goes on, as well as throwing out my normal watch list for things that are trading near key moving averages or particularly cheap or expensive implied volatility levels. Thanks again for watching the Harwood Report, and we'll talk to you next week.